Hey all, welcome back to another episode of the Enrich Your Journey podcast, episode number 18. I'm your host, Patrick Monahan, Senior Partner and Wealth Advisor at Trilogy. Just want to share a couple reminders for this episode. It's just been a little bit. First, the goal of the podcast is pretty simple. It's really just to host a fun, educational platform where you as the viewer may enrich your journey, hence the name, from where you stand today. Maybe you connect with just one episode. Again, we're on 18. Maybe it's this one today that inspires you to take action to better your future. So it's a simple goal of the podcast, just trying to help you all enrich your journey from where you are. And then second reminder, please continue to send me ideas for what you all want to hear about. I've got a few great episodes already lined up for this coming summer with guests, but please reach out with topics, advice you're looking for as it relates to wealth management, planning strategies, and or just ideas on enriching your journey. Those ideas do help me continue with the podcast, grow the reach, grow the brand, and at the end of the day, hopefully help you all as viewers. Okay, so today's episode, I thought I would talk about market volatility. This is a very relevant topic. We just went through extreme volatility towards the end of March of this year, 2025, through primarily all of April, really as it relates to the United States implementing tariffs. And we obviously had many inquiries from prospective clients, emails, calls, just folks that were concerned, looking for more information. That's very normal. I've been doing this for 18 years. Anytime you have a high volatility in a short amount of time, obviously it gets, grabs all of our attention and folks are reaching out. So I had a lot of great conversations in the past few weeks with folks, and I just thought I would touch base on that today because a lot of times we're sharing the same information and same ideas on what we think they should do as an investor, and that's really what I wanted to talk to you about today. Really the episode for this one is when we experience volatile periods in the market, what should you do as an investor? Should you make changes? Should you stay the course? And so I'm going to share a simple but powerful framework, really three key questions that can help you determine whether you should make a move during these turbulent times. We know the turbulent times will happen again. Markets go up, markets go down. They go up a heck of a lot more than they go down. But it's important to understand kind of where you stand. I'll back it up with, I've got a couple charts today showing why trying to time the market during these periods can often do you much more harm than they could good. So part one of this is really what I'll call the three confirmations. So let's jump right into the three questions you need to answer confidently to stay the course during turbulent times. Number one is, are you invested in high quality investments? This means your portfolio contains resilient assets such as large cap U.S. stocks, diversified index funds, bonds, fixed income, instruments that perform well typically during high periods of volatility. These things are less likely to, call it collapse during short-term shocks. So it's really important that you stay diversified, but you understand the quality of the investments that you're in. Number two, do you understand your risks for potential downside scenarios? So know what can go wrong. Are you prepared for a significant decline? I just said a moment ago, markets do go down. You need to understand what your risks are. Do you have a plan if your portfolio drops 20% or more? Do you have a plan for that? Can your financial plan, can your retirement plan, can it sustain a 20% drop? So awareness helps prevent panic selling. That's the number one thing that is on most clients' minds, investors' minds, when the market is really volatile and the headlines are scary. Are you potentially making irrational decisions, i.e. panic selling in that moment? So make sure, whoever you're working with, if your money is being professionally managed, which is obviously our suggestion, or if you're doing it on your own, just make sure that someone is proactively stress testing your portfolio. There's many technologies out there that allow you to understand hypothetical outcomes, although they are based on historical trends and data of upside markets, but importantly, downside market movements. So if you're uncomfortable with the potential outcomes in a downside scenario, utilizing a stress test scenario, then you very likely need to make an adjustment to your overall asset allocation and the risk in your portfolio. If the market's down 20 and you're down X percent compared to the overall general stock market and you're okay with that or you're comfortable with that, that's great. But if the market's down 20% and you're down close to that number, maybe more, and you're unaware of that or you're uncomfortable with that, you need to make changes when the time is appropriate. Number 3, do you understand your time horizon for this portfolio? When do you need access to these funds? If you're decades away from retirement, maybe short-term volatility shouldn't shake your long-term plan. But conversely, if you're nearing what we call the distribution phase or in retirement, where you're pulling assets out of your portfolio, you may need to adjust. But even then, patience often pays off. I share with clients all the time, just because it's important to understand, just because you're nearing retirement or you are retiring, your assets should still be designed to last for a long time, right? If you retire at 60, hypothetically, you live till 90, your portfolio still has 30 years where you need good performance on that to keep up, obviously, or outpace inflation. So just understand your time horizon on when you're going to be pulling assets out and what percentage of the portfolio you're pulling out for your retirement as well. Remember, market corrections, which are defined as 10% from peak to trough or top to bottom, are actually very common. They historically occur about one time per year since the inception of the stock market. Corrections can be very healthy, and they likely should really not deter you from modifying your allocation or plan, particularly if they happen in a short amount of time. So that's part 1. Just again, understand high quality investments, asset allocation and risk, and your time horizon. Part 2 is the one that we talk about probably the most with clients, prospects, friends, family, when they're concerned about what's going on in the market, if it's volatile, is really understanding the risks of trying to time the market. This is as old as the day, and it comes up a lot that folks are always trying to time it correctly, buy the low, sell the high. But if you go back and look, there is a million articles written about how it is damn near impossible to do that, and it's really it's a waste of time. It's too risky, and so let's look at some data that illustrates why attempting to predict short-term market movements during volatile periods is very typically a losing game. So I got a couple charts here. These are both written by some friends that we utilize, a fund family called Dimensional Fund Advisors. Very well-respected fund family. And they've got great, what I call client-ready or client-approved charts that do a great job just illustrating some past historical market trends. This first one is called Stock Gains Can Add Up After Big Declines. I love sharing this with prospective clients and clients. It just tells you, again, why not trying to time the market is really the best thing you can do. This is a long-standing time period here. It's actually from the inception of the stock market until this past December. So you've got a long set of data here. But again, a very, just a really important one theme here, and one that holds true to not making irrational short-term decisions. So the first chart here is return after a 10% market decline. I just explained that's considered a market correction, very normal. This is on the S&P 500. So if you do nothing after a 10% drop in the stock market, historically speaking, following the 1 year average cumulative return after the bottom of 10%, so that hits the 10% low, 12 months later, the market recovers 11.8% on average going back to 1926. 3 years, if you do nothing, so you rode the 10% down, 3-year average cumulative return is 34.6%, and the 5-year is 68.7%. So again, doing nothing but staying properly allocated, understanding risk, understanding quality, understanding time horizon. You do nothing during a market correction. Historically speaking, you are paid very handsomely to stay the course and ride out that sharp rebound that typically happens in the market. Second one's a little more dramatic. We call this a bear market. So instead of being down 10, the market's down 20. This is actually very close to where we just were in latter half of March and April of this year, 2025, again, due to the tariff conversations and movements that are happening right now in the U.S. So So market's down 20%, obviously much more alarming, right? 20% down, you got $1 million, you're down 200 grand, or the market's down 200 grand. That's a big move. But again, if you do nothing, you wait 1 year after a 20% decline, the stock market on average 12 months later is up 21.2%. 3 years is 42.5%, and 5 years is 74.9%. So it awards you by staying invested in this example. These are massive versus trying to sell, or you make a irrational panic selling decision at the bottom and you miss all that recovery. I've got another chart here to show that in a different way. And then the third one is really a recession. 30% down. These are obviously much more dramatic. They stay around much longer. Average recessions can last anywhere from a year and a half to 2 years. So they don't stay around for many, many years at times. Some of them last much longer than that. Technically, COVID was one that was just a couple months old. But needless to say, recessions are much different than a 10% correction. So the long-term return takes longer to get back, but the short-term return still performs very well. So even after a 30% decline, 1 year later, you're up 23.9, 24.5, and 50%. 3 and 5 years respectively. So I love this chart. It just shows that if you try to understand, talk to your advisor, have them walk you through how everything's performing, the income you're getting, by the way, throughout that time period from dividends and income, distributions and interest, that's all still happening. But again, the market rewards those that stay patient and stay invested along the way. The second chart I want to share, also from Dimensional Fund Advisors, is titled "What Happens When You Fail at Market Timing." I love this chart as well. This is a shorter time period, still over this is a 25-year time frame here on the Russell 3000, a large barometer of the entire significant amount of the stock market, overall stock market. So this is investing $1,000 in the Russell 3000 in 1998. If you did let that go for the 25-year period, at the end of 2022, your $1,000 is worth $6,356. So a significant gain in 25 years. However, during the periods of volatility over that 25-year time frame, if you missed the best 1 week, we're talking 5 trading sessions, a Monday through Friday, during that in 25-year time period, your total return is cut by $1,000. So instead of earning $6,300, you now have $5,300 on a $1,000 investment. So a huge difference just by missing five days. If you miss the best month, it goes down to $5,000. 3 months, $4,400, and 6 months, your return is 30-40% less at $4,000 by just missing 6 months, the best 6 months over that 25-year period. So again, it's best to stay put. Evidence suggests staying put through good times and bad. There's no way to proven way to time the market, targeting the best days or moving to the sidelines to avoid the worst. Evidence suggests that staying put through good times and bad, missing only a brief period of strong returns, can drastically impact overall performance. So just want to share those two slides. I think they're very relevant on trying to not let emotions, and I mean, we understand investing can be emotional. This can be a lot of money, can potentially impact your future, your retirement date, your actual retirement if you're in retirement, your next large purchase, your next large gift, whatever it may be. So emotions can be high, and that is certainly understandable with investing. Totally get that. It's just a great exercise to go through and look, how has the market done historically? I think that's always relevant. And can you check those 3 boxes of high quality, proper allocation, and understanding risks? So that's it for this episode. The conclusion is stay the course during periods of high volatility. Resist your temptation to make impulsive moves if you can confirm those 3 things. And your time horizon always needs to align with your needs. History shows that markets recover from downturns. Trying to time those usually results in missing out on the best days and the overall growth. Remember, investing isn't about avoiding all losses, but it's about managing risk and staying disciplined. If you've done your homework, the best thing you can often do is stay calm, stay invested, and keep your eyes on your long-term goals. So that's it for this episode. Thanks for tuning in to the Enrich Your Journey podcast. If you have found this helpful, please subscribe and share it with fellow investors. Please reach out if you have any questions. Would love to share these charts with you directly. And stay patient, stay informed, and keep investing wisely. Thanks so much. Take care.